So you guys know that I already own a few industrial companies in my dividend stock portfolio. I own 3M, ticker symbol MMM, the makers of this awesome whiteboard, Post-it brand 3M. Love this thing, love that company. My number 10 favorite dividend stock of all time. You know that I own United Technologies, ticker symbol UTX, my number 4 favorite dividend stock of all time. I'll link in the description below, by the way, to videos about that stock. And I've also mentioned in the past I own Caterpillar, ticker symbol CAT, the makers of heavy equipment that's used in industry and mining and so many use cases out there, construction as well. But I'm always looking for new companies. I own 38 stocks in my portfolio, but I'm a bit underweight on industrial. And this classical question comes up all the time. Ian, should you just stay focused? Should you just add to your industrial stocks that you already own? You guys know that I'm averaging into United Technologies right now. I keep buying more because that's my number 4 favorite stock of all time, and I want to bring it up to a bigger allocation in my dividend stock portfolio. But this question comes up all the time. Ian, should you add more industrial stocks to your portfolio? Ian, what do you think about Honeywell? And so I actually covered 3M recently. I got a bunch of comments on my YouTube channel asking me, hey Ian, what do you think about Honeywell? Do you think Honeywell is better than 3M? Do you think it's worse? How do they compare? I'm actually not comparing the two today, but I want to do a stock analysis of Honeywell because these questions, they really piqued my interest. And over the years, we have purchased a lot of Honeywell products. I consider Honeywell to be a really premium brand. In fact, it's very sad right now, but the state of California where I live, we have been devastated by wildfires, and there's been a lot of smoke. And so the smoke, the air quality, it is unhealthy to breathe right now. And what we actually did is we purchased an air purifier. And the first thing I asked my wife, hey, can you please purchase this air purifier online? And I really prefer if you would buy Honeywell brand. And the reason I knew that is actually a long time ago, I used to have a Honeywell air purifier, and I know that Honeywell makes really good quality products. So lo and behold, we received the air purifier. Here it is in the mail today. This is the box. This is the box of the air purifier, at least. And up here are some spare HEPA filters for the air purifier, and I'm already running it on full steam trying to clear up the air in our home. But I'm really pleased with this thing, and then it kind of triggered my interest again. I'm like, hey, I'm getting these comments about Honeywell. Just purchased the air purifier. I'm fond of this brand, and look, my bias is just to keep the number of positions in my portfolio to a minimum. It's to keep it at 38 because I already feel like I have probably a few too many stocks. But that said, as a dividend growth investor, I'm always tempted. Ian, should you add more stocks to your portfolio? Wouldn't it be exciting to buy more stocks? And so there's always kind of those two sides of the debate going on in my mind as I think about dividend stocks. But anyways, I want to do an analysis today. I want to share some thoughts on Honeywell. I spent some time today looking at Honeywell, analyzing this stock, have a lot of insights not only on Honeywell, but on the industrial sector as well, and why it may make sense to diversify a bit in this sector that most recently actually has had some bad news, primarily with a company called GE. I know a lot of you either own it or follow it, so I have some thoughts on GE today as well. A lot of cool stuff in today's video, so let's get started. So thanks again, everyone, for the amazing subscriber requests. This, again, is a subscriber request video. It truly means the world to me, all of the comments, the subscriptions, the likes. Look, I am not here on YouTube trying to pitch or trying to sell a subscription course. This is my best content. I am putting all of my effort right here. And so the best way that you can thank me for what I'm doing is through all of the support that this amazing community is bringing to the PPC and YouTube channel. So I thank you for that. So let's jump right into it. Off the bat, meta level, before I even get into the company, this is so amazing. Back in 2001, there was a proposed merger. There were talks of merger between Honeywell and GE. boy, you kind of think in life, like these what if scenarios. What if instead of going down this path, I went down this path? Or applying the same concept to a company. Instead of these two companies operating separately, what would have happened if they were merged? One case I could see is the whole thing just could have gone down together. Instead, in addition to GE having the troubles it's having in a merged company situation, perhaps both of them would have been facing horrible challenges. But by operating separately as they are, actually Honeywell is doing really well. But another what if scenario that's interesting is maybe if they were combined, all of the smart management practices from Honeywell, maybe they would have made it over to GE, and maybe GE would have fared a lot better than it has. And so it's interesting to kind of think about these what ifs. But quite frankly, this also points out how susceptible individual stocks are to risk. It's a fact of life. Look, I own 38 of them. Some people think I own too many dividend stocks, but I want to use my dividend income to pay bills. I want to live off of my dividend income. I rely on my dividend income. And so, but if I only own one or two stocks, what if one or two of those stocks was a GE type of situation? GE faced a dividend cut. It probably will not be reinstated for quite some time, in my opinion, at least to the prior levels. And if I were relying on GE dividend income to pay the bills, that would be problematic. But let's say I own a portfolio of 38 stocks like I do, and one of them out of the 38 is GE. That is a little bit easier to shoulder that risk. By the way, I don't own GE. I have some thoughts on GE. I'll link in the description below. I covered this stock a while ago. Check out that video if you want to learn more. But what is interesting in all of this is, look, Honeywell and GE, they were thinking of merging back in the day. And this just goes to show, boy, let's say I owned Honeywell before then. I had all the best intentions. I owned a really good company, but just because of fate, because of how these management teams thought would be best for both companies, let's say they merged and then the whole thing just kind of, the bottom fell out and they both faced problems. These are real risks, and this is the risk of owning an individual company in the stock market, and quite frankly, this is why I diversify. And so the thing is, especially in industrials, this is again a meta level point, but industrials, these are diversified companies. And I know there are a lot of subscribers out on my channel who really understand these companies, but I'm going to give you my honest opinion. I do not understand all of the intricacies of these businesses because these businesses do so many things. 3M, for example, has tens of thousands of products. How could I possibly be familiar with all of them? Honeywell, there's so many different divisions that I'm not familiar with every single division at the company. And so what happens, in my opinion, with a diversified industrial company is it is an industry where it's a bit more tricky to analyze. It's kind of like the technology industry. As a kind of a parallel, it's difficult to analyze. And because it's difficult to analyze, I think sometimes investors don't understand everything that's happening at a company, and sometimes they can be fooled. And I think that's what happened at GE. For a lot of years, no one knew what was happening at the company, and then all of a sudden, all of the bad news surfaced. They made a lot of bad acquisitions. They got way over-levered. Revenue is stagnating. They're facing challenges. They have too big of a workforce. They're having trouble with their cash flow. They're having trouble paying the dividend through cash flow, and it kind of all culminates. And I think now when we look back and we look at GE, people are still trying to uncover what the heck even happened there, because there are so many moving parts at that particular company. And the same can be said for anything in this industry. And so the reason I bring up this example again is kind of twofold. I think stocks carry risk, and sometimes it's just a matter of one split decision. I personally believe because Honeywell stayed separate, they have thrived and they've done well. I think though if the decision went a little bit differently and they merged, Honeywell could have been a really bad investment if it were part of GE. And so this is outside of the normal shareholders' control as well. So this just goes to show that decisions that are made over time can greatly affect your and my investments, and it's why I stay diversified. But the related point to all of this is especially tricky in the industrial space because these diversified industrials, they're kind of difficult to understand and they're kind of difficult to invest in. And so for that reason, one has to be extra careful, and maybe it is prudent to diversify a little bit more in this space, knowing that things can get a little bit wacky out there. So a lot of top level thoughts here, but I think it's really important to set the stage when talking about these types of companies. So anyways, just some simple Yahoo Finance data. Honeywell is trading really at a premium now. This is a company that's done really well. Market's been correcting lately, but this company hasn't corrected that much. This company is doing quite well. $144 share price, $106 billion market cap. Trailing 12 months PE is a 41, but that's kind of misleading because there were some one-time events in there due to taxes, tax law changes. And so the 2018 projected PE is about 18. So no value by any means, not a horrible price, at least the PE is not above 20, but at an 18, richly valued, fairly valued company at this level. And they pay a 82 cents dividend per quarter, or $3.28 per year. If I take $3.28, I divide by the current share price. The starting yield on this company is a lackluster 2.28. That's really low. The overall current yield of my portfolio, just not yield on cost, just portfolio dividends divided by current portfolio value, for me is about a 3.6%. So well below the average, but what they make up for it here is in growth. Over the last 5 years, they've grown the dividend from 45 cents to 82 cents. So the dividend over a 5-year period has gone up by 82%. So with a company like this, if someone does not need to tap into dividend income right away, if someone has some time on their hands and they need dividend income in the future, this kind of company is an interesting one because it's a real dividend growth company. They're growing the dividend quickly, but the current yield is not huge. The opportunity for yield on cost for future dividends divided by cost basis, the yield on cost is substantial with that 82%. And I think they can keep that up because the payout ratio is about a 41%. If I look at the projected EPS for 2018, which is $7.99, take the current dividends, $3.28, divide by $7.99, I get a payout ratio of about 41%. Real reasonable opportunities to grow. And so I had a subscriber actually bring up a question/comment on my channel. I look at 5-year dividend growth quite a bit, but the subscriber pointed out, Ian, can you also point out, please, the compound annual yearly dividend growth? And so when I look at a 5-year dividend growth rate, what I'm really looking at is just over the last 5 years in raw percentage terms, how much has the dividend grown? And so it's grown here by 82%. And it's really easy to compute that. I just take the current dividend, I subtract out the starting dividend from 5 years ago, and then I divide by the starting dividend from 5 years ago. Bam, that's the 5-year dividend growth rate. Easy for me to look at because I kind of look at chunks of time as at 5 years at a time. And so I like to project, okay, what if they raise it that much for the next 5? And then on top of that, I'll compound it out another 5, so on and so forth. And I'll just kind of use it to project that way because I look at things in kind of 5-year buckets. But anyways, I'm a little different than most investors out there. Most investors, most writers on the internet who are writing about personal finance, they use a metric called compound annual dividend growth and compound annual growth rate. And the way that this is computed is a little bit different. First, before I compute it, what is this metric? What this metric does is it looks at a period of time, how much the dividend has gone up, or how much any other financial metric has gone up. And then it looks, the equation basically tells you and me, okay, to see that growth rate over 5 years per se, what does it need to be on a yearly basis? What is the amount that it needs to be on a yearly basis? When compounded yearly over time, it will get from the starting point to the ending point. And so here's the equation. It's basically you take the ending value, which is 82 cents per quarter of dividends. You divide by the beginning value, which was 45 cents per quarter. And then you take it to the power of 1 divided by how many years of data you're looking at. So I'm looking at 5 years because I know the dividend went from 45 cents a quarter to 82 cents a quarter. It did that over a 5-year period. So 82 cents divided by 45 to the power of 1/5. Again, 5 years. And then after doing all of that, I subtract out 1. This will give the annual compounded growth rate. And the compounded growth rate here for Honeywell over the last 5 years has been 12.75%. What this means is, on average, each year, Honeywell has grown the dividend by 12.75%. That is really fabulous. It's just a fabulous growth rate. It's a quick growth rate. And it's another way just to look at dividend growth rates. Like I said, on my channel, historically, I've looked at the 5-year periods, but this is another way to look at it. Both, I think, are reasonable, great ways to look at it. Most financial analysts will look at it this way, as a compound annual growth rate, and so that's why I wanted to include that. And I do thank that subscriber for that feedback and that suggestion. I think this is valuable information for the community to be aware of. And now that you guys have the formula, anyone can go home and compute their own compound annual growth rates as well. So real excited about that. So the cash of this company is plus or minus 11.65 billion. The debt is plus or minus 18.25 billion. So this is, again, just what I pulled from Yahoo Finance. I'm trying to break this analysis into 2 parts. I'm just really showing you my personal methodology for analyzing stocks. And a key point here, why do I look at cash and I look at debt right off the bat? I know that this industry is plagued with debt. I know that GE got themselves into problems with debt. And I'll get into this later, but a fun note is GE has $115 billion in debt, according to Yahoo Finance at least. And so I know they're working to pay that down. They're divesting assets, they're selling assets to raise cash, to pay down debt, to fix their cash flow. So this is a number in flux. But I know, hey, GE once a world-class diversified industrial. Honeywell right now, world-class diversified industrial. And I kind of think, what if, again, what could hurt Honeywell? What could take them in the wrong direction? Well, one thing that could take them in the wrong direction is if they pull a GE, they do all these acquisitions, and they rack up debt. And not only do they do acquisitions that don't perform, and they rack up debt in the process. This is a huge risk of any business venture, but I know in this industry it's plagued GE. And so that's why I look at it right away. Off the bat, 18 billion in debt doesn't look too troubling. And it's up a little bit. It was 17.8 billion at the end of 17. So we'll get into that in a minute. I'll talk more about that later. Anyways, in fact, before I go on, just quickly, what does Honeywell do? What do these guys do? They have a few different divisions. They operate in aerospace, home and building, both commercial and residential. They operate in performance materials and safety. So I would say aerospace, they make parts, they make systems that are used in just most airplanes out there, from my understanding. And from the reading that I've done, their aerospace division is probably the most defensible division that they have at the company. Pretty cool. Now, I already own a company, United Technology, that also operates in aerospace, and they make jet engines through their Pratt & Whitney division. And so there's probably some overlap there. But my understanding from the best of my research is Honeywell isn't very big on the jet engines. It's more that they make a variety of systems that are used in airplanes. So kind of complementary, but similar business. In the home and building, I would say this right here, this falls into it. The air purifier, that's part of it. In fact, I'll tell you, the thermostat that we have in our home for our HVAC system, it is Honeywell, and they make a lot of thermostats. And so that is part of it as well. Again, residential and commercial. They have a lot of competitors there. Performance materials, I would say in the performance materials, you probably have some competition here between Honeywell and 3M. So again, some overlap with another position in my portfolio. And then safety, I know... honestly, I don't know too much about that, but my understanding is they also go head-to-head with 3M a bit there. So I know I have subscribers on my channel who actually work in this industry. They understand all of the things these companies do. So please do comment below the insights that you can bring to the community. They are really helpful, really appreciated. So please do comment on some of the things that you think Honeywell may be doing well, some of the things you think they may not be doing so well, and also just how they compare to other companies, because I know other investors out there on YouTube in the comments section have chosen to go Honeywell instead of 3M. I actually went with 3M over Honeywell. I don't own Honeywell yet. It's certainly on my watch list. I'm thinking about adding it at some point, but I have 38 stocks, so I'm in no rush. I would wait for a correction by then if I were to buy, but I certainly, it has piqued my interest. It's a company that I respect, and it's a company that we just use on a day-to-day basis, so it fits kind of the persona of the type of company that I like to own. What it comes down, though, to me is, look, should I just plow more money into UTX and 3M and just double down on the positions I already have, keep things simple, or do I need to add another one? I think at the end of the day, what it'll come down to is if Honeywell is ever on a deep discount sale, and I think it'll come down to if I just feel I need that diversification because of this kind of GE effect, the darling of Wall Street, the company that was really well managed at one point, and how it just unraveled over time, kind of behind the scenes with no one really detecting it until it just all faced trouble and challenges all at once in the last few years. And so because of the GE effect, should I have more industrials? I don't know. This is a decision I'll have to make over time. But I'd be curious, if you chose Honeywell over 3M, why did you do that? If you own both, why did you do that? Please participate in the comments below. It benefits everyone in our community. Anyways, what I did next is I looked at their annual report. I looked at their 2017 annual report, and I looked at the years 2013, 14, 15, 16, 17. The first thing that I look at with these guys is free cash flow. And the reason I look at free cash flow first is, quite frankly, they highlight it first. And the reason they highlight it first is there's a lot going on at the business. My understanding is they have divested some of their less profitable businesses. They've spun them off. And in doing so, revenue is not growing really quickly. Also, they've been taking advantage of the new tax code, and they've been repatriating dollars. They do a lot of international business. And in doing so, there have been some weirdness with their earnings per share. And so I think because of the revenue not going up too much, the earnings per share being wacky, they really wanted to highlight free cash flow. And so anyways, they have that kind of front and center. And free cash flow ultimately is what everyone can pay the bills with. And it goes from $3.388 billion in 2013 up to $4.935 in 2017. So free cash flow is up 46% in a 5-year period. Pretty astounding. That's a pretty quick growth rate. Now, not as quickly as the dividend is growing. The dividend's up 82%. And so if free cash flow keeps growing at this clip that it's growing at now, will they be able to grow the dividend in the next 5 years the same they did in the last 5 years? Maybe, maybe not. But at a certain time, it'll taper off. I think at a certain time, the dividend will start growing very similarly at a similar clip to free cash flow. Maybe once their payout ratio reaches like 60% or so, they'll probably taper it off. And so something to be aware of. But that free cash flow growth, it's astounding. It's very good, very impressive. Moving on to the next, this is a little hard to read here, but I looked at sales, revenue. Revenue is basically flat. Over the last 5 years, it's actually up only 4%. Goes from 39 billion to 40 billion, 40.5 billion. Again, it's a little misleading because revenue is impacted by some of the divestitures they've done over the years. Now, the EPS went from $4.99. It's actually up, and then it drops in 2017, so it's down 57%, but it's kind of misleading because what it should be for full year 17, or sorry, full year 18 is it's going to be $7.99. So 2017 was a wacky year. 2018 is going to be $7.99. It went from $4.99 to $7.99. So EPS is up. But again, just looking at the 2017 annual report, it's a little wacky because it goes from $4.99 down to $2.17 EPS down. It's my best understanding is it's because of tax code changes. So something else worth pointing, assets. Assets go up from 45 billion to 59 billion, so assets are growing. I don't place too much weight on assets because I think if the company ever had to sell off assets, they're going to get pennies on the dollar, and I think these things are usually carried on the books higher than they're worth. That being said, liabilities are a lot lower. They go from 8.8 billion up to 17.8. Debt's actually higher now at 18.25, but end of 17.8. Clearly, assets are greater than liabilities. There is stockholders' equity in this company. I get a lot of comments here on my YouTube channel. Ian, why do you invest in companies that have negative stockholders' equity? Why don't you look for companies that have stockholders' equity? Maybe I'm right, maybe I'm wrong. I think I'm right. I don't really place too much value in stockholders' equity, and the reason is twofold. One, the types of companies I own are very predictable, so as soon as cash is coming in, they pay it out as dividends. By contrast, if I owned a bunch of companies that just hoarded their cash, they kept it to themselves, stockholders' equity would be through the roof because they'd have all this cash on their books. But companies I own typically don't have a lot of cash on their books because they pay it out, and that lowers stockholders' equity, but it gets the cash in my hands so I can use it to pay bills rather than sitting in a corporate bank account where it can be squandered on something. And so I prefer those kind of companies. But the other reason I don't place a lot of value on stockholders' equity is because assets in general on most companies, in my opinion, are carried way higher on the books than they should be. So I don't even know if the stockholders' equity is real or not. But theoretically, a lot of investors like to have companies where assets are greater than liabilities, so that when you subtract liabilities from assets, there's stockholders' equity left over. And there's ability, quite frankly, if someone just had to pay all their debt down tomorrow, they could do that through assets. So that's why a lot of investors like that metric. Personally, I don't mind having a negative or zero stockholders' equity. But what I do mind is if liabilities are too high. So especially in this industry, because that's how GE got into a lot of trouble. But anyways, let's look at liabilities. So I look at liabilities, they're $17.8 billion. What I do here is I just say, in their 10K somewhere, there's going to be debt servicing. I didn't take the time to look at it, but I just look hypothetically, interest-only loan, 5% per year. How much interest are they paying on this almost $18 billion of debt? Well, at a 5% interest rate, to carry that debt forward, the interest that they're going to pay on that at a 5% interest rate is about $894 million a year. They can clearly cover $894 million per year in interest expense because their free cash flow is about $5 billion. It's $4.9 billion. So it's 5 times the debt amount and the debt servicing amount. And so, again, on like an interest-only 5% loan. And so from that vantage point, I think the debt they have here is very manageable. It does not scare me. I like it, although it is going up. And so, as is the case with most companies out there. But to be fair, debt's going up, so is free cash flow, so are assets. And so they've got a lot of things going up. If there's one critique I would have, boy, it'd be nice to see debt kind of more plateauing, not going up. But it's not a concern. It's not very high. And again, interest expense on something like this is not overwhelming. By contrast, if these guys had, say, $100 billion of debt or 115 like GE, that would be very concerning. That would be too much debt. It would be hard to service that debt. It would be hard to turn a profit with that kind of debt, given the scale of this company and the type of free cash flow that they're driving. Something else, just a fun comparison here. I've done some videos here on my channel about IBM. This is completely different industry, tech stock. But I just want to give kind of a fun comparison because we're talking about cash flow today. Free cash flow here about $5 billion. IBM free cash flow is about $12 billion. That's what they're projecting for this year. Now, what's funny is the market capitalization of Honeywell versus IBM. Very similar. IBM is just over $100 billion. These guys are $106 billion. So kind of similar ranges for market caps. But here you're buying $5 billion of free cash flow, whereas at IBM you're buying 12. And so that is the market pricing risk. The market sees substantially more risk with a company like IBM because they just paid a boatload of money for Red Hat and no one knows if the acquisition will work or not. I tend to think it will, but it is probably the biggest risk that company has ever taken. And quite frankly, it's probably one of the biggest risks any company has taken this year in 2018. And also IBM is facing some challenges with stagnating revenues, where overall this company, whereas the 10K implies revenues are stagnating, they're not really stagnating. The company is showing some solid growth. And so that's the difference. But that's the difference between risk and less risk. And the market right now is pricing a lot more risk with IBM, and that's why it's trading just at a completely different cash flow multiple than something like Honeywell. So, a lot to take in here. Fun, just quick look. This is what I do. This is literally what I do every day. I spend time. This is not obviously a very in-depth analysis, but this is a start. This is how I familiarize myself with companies. When something piques my interest, when I want to look at something, this is the first step that I take, and then I put it on the watch list. I will watch this company. I'm not going to make any moves here. This thing is yielding only 2.28, trading near its all-time high. I will wait because the industrial sector, it is highly cyclical. It has peaks and valleys. It is tied to industrial demand, and I think there could be some buying opportunities coming up. So rather than start buying today, I'd rather wait. Although, who knows? You just never know. Certainly, I already own 3M. I already own UTX. I own Caterpillar as well, but that's kind of real different. But they're all industrials. And I would say at this point, I would like to just continue to stay focused on my strategy. My strategy for 2019, by the way, is adding to my top 10 stocks, core positions, staying focused on those. And 3M and UTX are both in the top 10. So right now, as I see it, I'm going to add to those. I'm going to stay focused on those, but I'm going to continue to watch Honeywell. I want to learn more about it because of the GE factor. Maybe at some point it makes sense for me to diversify just a bit more in this industry that's kind of has been tumultuous, at least for GE, and can be a little bit just confusing at these companies because they're conglomerates. They got a lot going on. So I'd be curious, share your strategies, share your thoughts. What stocks are you looking at right now? This is just one of the many that I recently added to my watch list. And I'll give you a closing thought today, by the way. I have a strategy for next year, stay focused on the top 10. I'll probably deviate from it a little bit. I'm going to try to stay focused on my top 10, but I'm a dividend investor. I love buying stocks. I love looking for opportunities, and so opportunities are going to pop out throughout 2019. I'm going to take advantage of them. Who knows, I may even add a new stock to my portfolio. Got 38, but if I went to 40, I'd have no problem doing that. So it's always evolving. It's always fun. I always enjoy staying in the game. And so everything is on the table for me, but my primary focus is going to be those top 10. But I'd be curious, which ones are on your watch list right now? And are any of the ones on your watch list on sale, or some of them like this one where it's kind of fully priced, but it's still fun to watch because it's a really fabulous company? Be real interested what you think. So thank you for watching the video today, everyone. Before I leave, in terms of a full disclosure, I own the stocks mentioned today in my personal stock portfolio, or at least a bunch of them. I am long. I own stock in 3M, ticker symbol MMM, United Technologies, ticker symbol UTX, Caterpillar, ticker symbol CAT, and IBM, ticker symbol IBM. Also Cedar Fair, ticker symbol FUN, although I didn't discuss that, but I put fund notes here. So just in case, I own that one too, Fund Master Limited Partnership. I'll link in the description below if you haven't seen that one. It's a fun stock, did a really fun analysis. Check that one out. So I own those stocks in my personal stock portfolio. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. This video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. Literally just sharing my personal journey here on YouTube for fun. Thanks so much for watching, everyone. Wishing you all an incredibly happy Thanksgiving, an incredibly happy holiday season, and just fun celebration, fun times with friends and family. I am praying also for everyone out there in California affected by these wildfires, sending my thoughts and prayers. And by the way, if you know of a really good charity related to the wildfires, I have a few that I'm looking at right now. I do want to donate money. I want to support the cause. I want to give back. I think that's a really important part of dividend investing, is not just thinking about oneself and one's family, but thinking, how can dividends add back to everyone? How can they add promise and value for others out there? And so I'm going to use some of my personal funds to give back, to help. And probably what I'm going to do actually is there was the Chico County firefighters, or not firefighters, the sheriff's office. I think they had a fund being established to help the employees and the police officers that are part of that sheriff's office. That's one that I found that is kind of the leader on the list right now. I think that's where I'm probably headed in terms of donating some money. But I would be curious, please share below if you have any other worthwhile charities related to the wildfires. That's something that I feel important. I feel it's real important for myself, my family to contribute, to help, and to pray for the people facing those challenges. And so please include that in the comments below if you have any ideas. All right, everyone. I will see you in the next dividend investing video.